First up, South African banks have had a tough time overseas as of late. Now, Investec Bank took large impairments in its property loan book in Australia, while Standard Bank had to reduce its headcount in London. Basel requirements have meant that more capital has to be held against risky assets, meaning, of course, the ability of banks to generate profits like they enjoyed in the past will be much more difficult. Joining us from our Cape Town studios to discuss the prospects for banks and financials in general, Patrice Rassou, Head of Equities at SIM. Patrice, good as always to have you on the show. So we've been talking about the financial sector, and it appears this year, they have had a good run. We're looking at them being up rather 30% year to date. What would you say is the sentiment around the sector as a whole right now?
Thanks for that question. I think what's quite interesting is our banks, especially in a global context, have been seen as a safe haven given what's been happening internationally. So it's quite rare to see our own banks trading at a premium to emerging market banks. And they've been trading at a premium actually to global banks, simply because our banks are often seen as being ex-growth versus the rest of emerging markets. So we've been in a situation where a lot of investors who ignored South African banks have come in and bought these banks, given the fact that they're delivering very good earnings. And we could see that from the recent raft of results, with some of the banks delivering earnings, well into the 20% plus, which shows that they're definitely not ex-growth as some people thought. So right now, with very low interest rates in South Africa, I mean, we're back to the 1970s, prospects are fairly benign, although there's some concerns starting to emerge with bad debts having bottomed. And there are prospects going forward, if interest rates do go up, that bad debts might start to go up from these levels on, which would mean that earnings growth is going to be a lot more difficult to come by in South Africa.
Patrice, obviously a lot of that income, that growth in earnings has come from the switch from secured lending into unsecured lending, and a lot of it's been said, being talked about in the markets at the moment. What's your take on the conduct specifically of the big four banks? Are they lending responsibly, and do we face a bubble in the unsecured lending market?
Well, I think, Warren, this is a very good question, because I think the performance of our banks really in the retail space has been linked to the fact that some of them have switched into more unsecured lending. It's no surprise that the banks which have been more aggressive in the unsecured space, especially FirstRand and Nedbank, have been the ones who have printed the 24%, 26% earnings growth in the past year. Those more conservative, take the case of Absa, have really missed out on that mini boom, as you refer to, in unsecured lending. Actually, Absa posted results down 10% at the interim, simply because it had to take provisions against its secured lending. So when we look at this in context, though, versus the pure play monoline microlenders like African Bank and Capitec, the big four banks are really lagging behind. They are not taking market share from the monolines, who are really growing their advances books at rates of 40% plus per annum. So while they are growing quite fast versus their relatively small base, they are lagging behind the actual pure play microlenders.
So just in terms of that, Patrice, are you worried about the rate of growth of that unsecured lending market?
I think one always worries when we see rates of growth well above, the fundamentals, which is disposable income growth, employment growth, GDP growth. So one has to ask oneself, where is this growth coming from? I think initially, one has got to accept that there was a big deficit in terms of penetration and credit penetration in the sort of broader mass market. But I think that's been more or less filled. And what we're seeing more recently, and that's comments from the likes of African Bank acknowledging that, is that the players are starting to lend into the mass market, which, as you know, by and large is a very well-serviced in the middle market, which is by and large a well-serviced market where customers there have got existing loans, especially secured loans. So I think that's where the concerns start to arise. If you're going to offer an unsecured loan at yields of 40% plus to someone who already has got some kind of debt, The risk is when interest rates go up, this person might find it very difficult to service his unsecured debt. So I think we're getting to a point that the market is very well penetrated now, and growth is going to be very hard to come by.
Patrice, when we do get to that situation, as you say, when eventually the lending cycle turns and the interest rate cycle turns, rather, is that entering new territory for South Africa? Have we ever been in a space like this before, where we've seen, a surge in lending, particularly to a market that already has debt, and they're going to have to contend with higher interest rates?
It's always quite tricky to find out what the trigger to prick the bubble or to burst the bubble will be. Interest rates as such in the unsecured market is not always a fundamental problem, because a lot of these loans are fixed rate loans. So if the only debt that you have is an unsecured loan at a fixed rate, interest rates going up is not going to affect you. If you have other floating rate loans, then obviously you're going to be squeezed. Unemployment might be a big issue. If you lose your job, obviously it makes it very difficult for you to service debt. Maybe just a slowdown in terms of the type of income that this customer base might be able to generate might also be a problem. Or inflation, food inflation, for instance, which might be building up. If that comes through as a problem, you might find that disposable income gets squeezed, and the ability of the consumer to service debt might prove a problem. It's hard to find out what the trigger will be, but I think the issue is that this market has been in a purple patch, and if things turn around, interest rates go up, growth slows down, unemployment starts to tick up, we might see that the level of bad debts, which in that market has been very, very well behaved, starts to tick up and obviously depresses profitability.
Patrice, you mentioned that in Absa, the likes of Absa might have missed the boat, and some commentators have been referring to perhaps a lack of experience at the executive level, with some of the senior executives moving on, either retiring or moving elsewhere. What's your take on in terms of the experience and capabilities of the team at Absa at this point?
Yeah, good question, Warren. I guess Absa has got the memory of Unifer, which, if you recall, that a decade ago, Unifer hit the wall. It was involved in micro lending, and it got into trouble and had to be rescued by Absa, which because it was one of its subsidiaries. So maybe in that context, Absa has been down that road before and had paid school fees. Maybe that explains why they are more cautious. But in terms of judging management, the crux of your question, I think you need to judge management through a cycle. Yes, it seems at this point in time that they missed the boat, but if things were to turn, if that bubble were to unravel, they also would probably be the bank which would be the least affected. So to judge them now, I think it may be too early. I think let's see how this bubble unfolds, or how this cycle unfolds, and how they perform, over a full cycle, and then we'll be able to decide whether they made the right decision or not.
Yeah, because they have really reiterated the fact that they have been prudent when it comes to that, and chosen to take a more conservative stance. When it comes to stock prices right now, of course, you mentioned the fact that FirstRand, Nedbank, the stocks that have rallied the most as a result of the fact that they've really benefited from the hefty margins in the unsecured space. FirstRand up 35% this year, Nedbank up 25%, and then you say Standard a laggard. And then, of course, Absa still sitting below the price that started off the year. Of the four stocks, which is your top pick right now?
Yeah, look, we tend to be value investors, so we look for stocks where valuations are attractive. Actually, we quite like Investec, which is trading close to book value. We think that Absa, having pulled back, looks interesting. It's got a lot of excess capital. The new Basel III type of regulations which have come out seems to favor banks with excess capital. It's not too onerous. So that's also interesting. And Standard Bank also with its own problems. So as you can see, we tend to favor those with attractive valuations, which have got turnaround potential, which the market really is disregarding and sort of the real unloved stocks in the market rather than the ones which have done very well.
Just in terms of that Basel III or Basel III requirements, depending on which way you pronounce it, Patrice, where are South African banks in terms of meeting those requirements?
Yeah, I think we've got very recently, last week, some indications of the type of requirement that the regulator would come up with. I think there was a lot of concern in the market that the banking regulator might come up with very demanding targets for our local banks. And if you look at the past sets of results, the banks have focused on a lot on proving that they were conserving a lot of capital, and they would be able to meet the norms that have been set overseas. What's turned out to be the case is the regulator, especially in terms of what they call tier one capital, just basically the equity of the company. The target that has been mooted is a lot less demanding than what all the banks have been aiming for, which means that it looks like now they'll be able to meet that fairly easily. Obviously, there's one or two smaller details in the footprint that haven't been clarified, but I think the general message is that our bank should be able to meet the targets from the regulator. We don't expect to see, like we've seen in Europe and in other countries, huge capital raisings to boost the level of capital in our banks. And again, I think that adds to the attractiveness of the South African banking sector.
Patrice, we haven't mentioned the insurers yet. There have been the drivers behind some of the performance that we've seen overall in the financial space. Sector mean PE sitting at 12.7. Are there any insurers right now that are still attractive?
Yeah, insurers, I mean, it's been interesting. It's been a very defensive sector, high dividend yield. They've re-rated a lot. We'll tend to look at them versus what is called the embedded value, which is the NAV plus, you know, the discounted cash flows from the business they've written. Old Mutual for me still stand out, despite having been one of the better performers, as an interesting one, trading at 20% plus discount to its embedded value. It has the potential to pay a much larger dividend going forward once its debt burden overseas has been paid down, which it's busy doing very aggressively. And I think the management are saying the right things in terms of strategy. They're a lot more conservative than they've been in the past. They're not talking about acquisitions or growing the business. It's sticking to the knitting, doing where they focusing on where they're good at, and I think there's still potential there. I think it's still an interesting play in the insurance sector.